Goodness gracious. I'm not sure what was going on. All right, it was not letting me log in. How you guys doing today? All right, we're gonna go ahead and hop right into it because it looks like I'm the one that's late today, even though I was having some technical difficulties. We're gonna go over part two today of market structure. So hold tight for me one moment. I'm gonna go ahead and share my screen, and we're gonna go ahead and hop into the lesson. If you guys have any questions along the way, feel free to stop me, and we'll cover any questions or anything that you guys may be concerned about or have any questions about. All right. So we went over kind of like the basics of market structure. We're going to get a little bit deeper into it today. One second, let me pull up the slideshow. Can you guys see my screen okay?
Yeah.
Okay, awesome. All right, so yesterday we went over a few notes, just kind of going over what market structure actually is. And today is going to be a little bit more visual because obviously looking at TradeView, there's a lot of different components on there, and between the pricing, everything on the side, and I just kind of wanted to dumb it down just a little bit, not to call anybody dumb or anything, but just to make it a little more simpler for you guys to digest because people can get overwhelmed by all the lines and everything else. And I already have my chart set up a certain way. And I want you guys to at least just understand what you're looking for. All right. So in a nutshell, let me minimize this. In a nutshell, when you're looking at market structure, obviously there's three phases, right? There's uptrend, there's consolidation, and there's downtrend. There's a few different categories within each of those sectors, but this is mainly what you want to be looking at. It does say stay out right here, but if you are doing a scalping strategy, this is where you can still make some money because clearly there's still waves. And what I want you guys to think about when we're thinking about market structure and we're thinking about the markets is I want you to think about the fact that they're waves. They're waves of information. They're waves of prices going up and down. All right. So that's how you guys can kind of internalize what actual market structure is. All right. So if we're in an uptrend, obviously you want to be buying, kind of covered that yesterday. If you're in a downtrend, you want to be selling. One second. It is up. Okay. So this is kind of what I was talking about, where it just kind of looks crazy when you have a whole bunch of candlesticks and it's kind of hard to tell what's an uptrend, what's a downtrend sometimes. And it's always easier when you look at it as waves versus trying to see every single candlestick that you're viewing and trying to find out what part of market structure it's in. And instead of this, you want to have the mindset more like this. You got me, and you can see, as I'm gonna go back one. So you see how it's trying to calculate, or the line is going with every up and down swing, right? Whereas you want to see moves like this. This is how you want to be viewing market structure. All right. I'm gonna go back one more time because obviously things can get crazy, up and down, up and down, up and down. But you want to look at it as the bigger movements, right? So if we're gonna go all the way up and all the way down, right? This is how you want to be looking at it as waves instead of just each and every movement kind of trying to get into the markets that way. Tomorrow we're gonna cover your trading plan. We're gonna cover your how to enter the market again, and then we're also gonna cover the different lot sizes and how to use the lot sizes so you know where to start your accounts at. I'm gonna give you guys a little glimpse of that before the end of this session. Are there any questions before I go getting a little bit deeper with the market structure? So we have uptrend, downtrend, and consolidation. That's the main three phases of market structure you want to look in, want to remember. Finish pulling up my notes. All right. So the other thing I want you guys to think about is the fact that the uptrends, those are impulses, and the downtrends, the downswings, those are market corrections. All right. That's how you want to think about it. So, and all that means is the impulses is, like I said, it can be either from the banks opening and placing a multitude of orders, or it can just be, the consensus of the market saying, hey, we want to make the price go higher. Those are impulses, right? The market is impulsing, it's pulsing up. And when I say correction, that means the market is kind of trying to figure out exactly what the good price is. The same thing with gas, right? Gas goes up and down all the time. Obviously, you know, if the gas got to $5, you're gonna be like, whoa, I don't even want to go outside today. I'm not even going around the corner, nonetheless, you know, leaving the house, right? But when it comes down to the downtrend or the correction, you're gonna wait till gas gets to about $3 before you go outside and go grab some gas, right? You're not just gonna go find the first place you see $5 a gallon. You're gonna wait till it gets around $2, 2.25, something like that, right? Same thing here. If we're riding it up, impulsing, right, and we're watching it go down, we want to wait for the next impulse before we get in. And this is clearly in a downtrending market, but it doesn't mean you can't make money while it's going down. It just means that we need to be on the right side of things, which is a sell, right? If we're looking at this specific chart specifically, and it's showing that, hey, price started over here in this area, right, and it's finished in here, we should have been for a sell. And so looking at it as waves instead of, you know, the every single, this is how what they call getting chopped up in the market, because you think it's going up, and then it goes back down again, think it's going up, and then it goes back down again. This is where you get chopped up in the market, and you end up getting stop lossed out most of your trades because you weren't looking at the bigger picture, and you were looking more for the quick money, is how I look at that. You know, if you're looking at the bigger picture, you're looking for longer trades, right? You're looking for to hold trades for the max profitability. All right. So when I was talking about impulses, right? So impulses are these swings, the market sentiment, the consensus of the market is saying, hey, we want to buy, right? And when you have correction, that's the red area, those are basically just saying, hey, price got too high. We need to tell it down some. We need to get to a price where everybody can agree on, and then we'll have another impulse, and then we have another price that we can agree on, and then we'll have another impulse. And that's all the market does, technically. I'm gonna kind of apply this to gold right now. So I'm gonna switch over to the actual charts right now. And if you guys have been following, if you don't have the TradingView app downloaded, that is something I can help you guys out with during the trade account setup. So not only do I help you get your TradingView set up, if you don't already have it, it's pretty simple, but I can give you a referral link. If you don't necessarily need the paid version, you're fine with the free version. It doesn't have all the bells and whistles, but you have everything you need to trade successfully, especially as a beginner. And then once you understand how to manipulate the different tools that they have here, horizontal lines, the rays, extended lines, and Fibonacci's and all those different things, then you can kind of move forward to getting a paid version. You might need multiple screens, but right now, we're only trading one screen right now, one market, so you don't necessarily need it. But if you were looking at yesterday, gold was around 2740, so obviously we got a boost. So that's what you would call an impulse in the market, because sentiment of the market said price was cheap, and it rose back up, and that was after being down about 400 pips. You got me? So give me 1 second. See if we're going to use this. All right. So we're going to go to the week time frame real quick. Go to the week time frame and see if we can identify some market structure. I'm going to go back in history a little bit. Close this in a little bit. Okay. So perfect. All right, so same thing on the chart. This is just real live action, right? But in a nutshell, what we're looking at is we're just trying to identify when it's a good time to get into the market. And I know we're going to cover this a little bit more tomorrow on how to actually enter the market, but just being able to identify where you're at in the current market, right? So let's say nothing exists past this area right here, all the way to the right. Just kind of block that out in your mind for just a moment. And right now, if I'm right here and I'm seeing the market go up, and then I'm seeing the market go down, so impulse, correction, impulse, right, and then consolidation, right? And so we have that consolidation, and so sooner or later impulse is going to happen again. And if you look right here, this is what we're looking for right here: a strong movement towards an EMA, an exponential moving average, or a strong movement towards a support or resistance area. That's what we're always looking for, because if there's a strong movement in one direction, there's going to be a strong movement back in the other direction. And that's the key time to get in And ideally, you know, you would have got in right here, and then you probably would have exited around right here, ideally around right here because of these areas right here. Because of this area right here, that one there, and get another of those circles. Yep. So hard to grab these circles. All right. All right. So let's say you saw the fact that we had an impulse, we had a market correction, another impulse, then went to kind of consolidation, and you can mainly tell consolidation from any other movement because the candles are smaller, right? That means there's less volatility, less price action going on, less trading going on. So now that you know that, now you can make your decision based off of the market structure. And so we're at basically whatever caused this right here might have been just the market opening and a whole bunch of sell trades came in and came down right here. Second candle in a row, but it actually had a low of 1805, right? And in a nutshell, we would have ideal price would have been to get in right here and get out about right here because of the resistance area, right? Resistance all the way, get a line in there. So just a little bit. Okay. So raise this up just a little bit. So, and just so you know, when you are drawing your support and resistance lines, you want to make sure that your candles are touching as many bases of the candlesticks as possible. We don't go off of wicks because wicks obviously that's price rejection. It means price went there, but it never stayed there. And so we want to base any line that you're trying to draw on the chart. You want to make sure it's based around a multitude of the bodies of the candles, not just the tips of the wicks, right? So if anything, it would be right here. So honestly, right here is where we should have got in at, and then right here somewhere is where we should have exited at. Now, when I show you guys how to take profits or move your stop losses into stop profits, then yeah, you might have been able to take advantage of the price going all the way up here. And that's a simple thing. So don't think it's too much more you got to do. You're literally just changing a number. From let's say if you got in right here at 1825, you would have had your stop loss maybe at 1800, right? So when it came up here, you would have been in a profitable trade. 2014. That's a lot of movement over 1, 2, 3, several weeks. Now at that point, if you were holding a trade for several weeks, there's some people do hold trades for a month. I'm just kind of giving you guys a hypothetical situation. But ideally, if you would have kept that trade open, you would have moved your stop loss that was down here somewhere 1800 to about 1995 or somewhere. So it would have been a stop profit. You got me? And that way, when it did come back down here, you would have gotten the trade would have closed out for you automatically, but it would have closed out in the profits for you because we went in for a buy right here. All right. Any questions over that kind of scenario that I just went over just now? All right, cool. So once again, all we're looking for with market structure, we just want a complete understanding of what could possibly happen next. So I told you guys kind of not to pay attention to anything on the right from like here to here. And that's just because I want you guys to understand when you're looking at these markets, obviously, you know, there's big swings like this, right? And the part that you want to look at, let me go back to the slide. But the part you want to look at is these substructure right here, and then swings, right? Swings up in substructure doesn't mean you can't make money where the red areas are. It just means that you need to be in for a sell because you see that the market has exhausted its price, got as much volatility, out as possible, and then it started kind of subsiding and market correcting, and then impulsed again, same thing. You got me? So this is where you need to be looking for sells. This is where you need to be looking for buys. All right. The more you do it, the more it kind of comes second nature. Market structure is where you want to start at with any trading plan, because if whatever you need, whatever your trading plan is or whatever your strategy is, it's going to be based around market structure, and you're going to want to know what your signal is to get into the market and to get out of the market. All right. I'm going to open up the broker, or I'm sorry, I'm going to open up Trading View one more time. Let me see. open up one of these accounts. Let's see, we'll go to. I'm going to show you guys how to open up a demo account real quick. If you guys already have your accounts open. So, oh, God, goodness gracious. All right, hold on one second. Let me stop sharing for just a moment. But I'm going to show you guys how to open up a demo account so that you guys can start placing trades on your own. I know that's kind of like the next step, but I want you guys to be ready for class tomorrow. So if you have any questions, just reach out, DM me. If you have time tomorrow, sit down with me and I'll help you guys open up an account for yourself. Everything is within the student email as well. Give me one moment. Because I want to show you guys how easy it is to open up a demo account. And all a demo account is a way to practice your trading strategies. And it doesn't, there's no penalty for it outside of the fact that you just learned something new. You know, so it's really tough to risk money, especially when you don't know what you're doing. That's one of the reasons why I do trade live for you guys. You never want to be risking money that you can't afford to lose. Meaning, if it's your last $100, that's not. And I'm gonna tell you the main reason why. It's not because it's your last $100. It's because when you're in the market and you have your last $100 riding in the market, it's gonna be hard for you to make a trade that's based off of the markets and not your own emotional fear of you losing your money. You got me? And that's super huge in this because there's a huge psychological. You've heard me talk about it before, but there's a huge psychological aspect to trading that you want to master at some point. There's levels to it. Controlling your emotions, controlling your insight to the market, and making sure that your trading view isn't flawed by your emotional view. All right, that's super huge in this level of investing. Give me one second. Share my screen again. So when you do get here, you're going to go to accounts, and then you're going to go to add demo account. You can pick any of these. It doesn't necessarily matter. I'm going to go VIP account again, and you can have different, obviously you want to use USD, but there clearly is, different currencies that you can have on here. We are trading Forex or foreign exchange. So, there are multiple currencies that you can do. So we'll do $100,000 account. And I just want you guys to see what placing a trade actually looks like. So that you guys can see the power of, did I put the right account? If I did, I think I did. Okay, no, I did not. Give me 1 second. And then I will open up the floor for questions. Give me 1 second. I think I need to. So you definitely got to set up a password before US name, before you just go ahead and start trading the markets. And you do that by just going here. You can have as many accounts and demo accounts as you want. And the way that you use that is if you're having multiple trading strategies, you can test as many trading let's say you have 3 different trading strategies, you can put those all on separate demo accounts. And so you just to let you guys know, you only need one trading strategy to be profitable. But when the markets get a little crazy, you want to be able to have multiple trading strategies that help you out during certain times of market structure. So you want to have a trading plan for an uptrend. I'm sorry, a trading strategy for uptrend. You want to have a trading strategy for a downtrend, and then you want to have a trading strategy for consolidation. Even though it says stays out on that on the slide doesn't necessarily mean that you have to stay out. It just means that clearly, if you're looking for a long-term trade, you'd want to stay out. So that's just kind of personal preference on who you are as a trader. If you don't know that until you start trading, and the only way you really want to do that so you don't lose any money is by doing it on an account where there's no money in it. All right. So we're gonna go ahead. Did it not do it? Or all right, it's cool. I'm just gonna go. Okay, cool. We'll just call it this account right here. I really wanted it. All right. So all we're doing, you click this button right here. I think I did go over the different type of orders that there are. There's in action, like live trades, and then there's stop limits, buy limits, sell limits and buy limits, and then it's buy stops and sell stops. And I will go, that's going to be a different class for a different time. We're going to do a lot size, and I just want to reiterate this. I know I kind of already told you guys this before, but you always want to do a lot size of 0.01 starting off, all right? 0.01 starting off. We're in gold, so we're going to do, let's see, we're actually going to do market price. So we're going to go, the price, what mark is that? Price. So this is the prices down here. So let's do 2,700 for a stop loss, and then a 2,765. And this isn't by any means. I just want you guys to see what a trade looks like, so you guys can at least get a visual of what it actually looks like. And I'm hoping it closes while we're on this in like next 2 minutes or something, but I don't think so because the market's literally just opened back up, so it's not a lot of volatility. All right, 27.65. So I just got in for a buy. All I did was click buy. I'm going to go monitor my trade. All right. So once again, I'm going to run through these again. So your trade ID right here, the market that you got into, the action that you chose, buy or sell, right? And then the lot size, which is 0.01, not 0.10. And all this means is 1 penny per pip. So that's why you're seeing this net profit right here. You're seeing it's down 2.6, right? So that's where this is coming from, on top of the 4-cent commission that is automatically taken out. So just once again, I think I might have said this before in the class, but the broker is going to make their money whether you win or lose a trade, right? So keep that in mind, and you always want to account for that when you are placing a trade. Sometimes the commissions are different depending on what kind of account you chose. So if you have any questions about that, I can answer those now, but that's kind of for a different class. So we have the opening price and pips. Just so you guys know, pips are literally the measurements of how the market is moving. So right now we got in at 2763.86. That's when I hit the buy button, or at least that's when the broker registered my trade, or when they put the trade in for me. My stop loss is at 2,700, and then my take profit is at 2765, and that's just because I'm trying to get it to close. So because I want you guys to see what a trade will just close out and it'll just disappear completely off the map, but your profit would be right here on the balance. All right. So and obviously this is not what you want. This is not in any representation of what a trade looks like. All right, let me do you guys justice real quick. Let me just do you guys justice of what a trade is actually supposed to look like. Because I know I told you guys a 4-to-1 ratio is ideally what you want at the beginning. Honestly, if you can get a 1-to-1 ratio, that's what you want to get. So we'll stick to that. So I'm gonna do 2773 take profit. And then I'm gonna do 2753. And that's a 1-to-1 ratio right there. So now we're going to go back over here. That's still a little short, but it's mainly probably because of where are we at? Let's see, let's be a little more exact. 2760, 73, 86. Stop loss 753, 86. All right. So this is a 1-to-1 ratio right here. If you're looking where it says loss potential and profit potential, and it's $10 up, $10 down, that is a 1-to-1 ratio. So if I was looking for a 1-to-4 ratio, then that means I'd be looking at 2786. I believe. Nope. So now that's a 1-to-3 ratio. So like I said, you want to start off 1-to-1. If you can get a 1-to-1, ideally that's where you want to be at. But I just want you guys to see how the markets move. You got me? And if you were to bid a larger lot size in, and obviously it would be a lot more money, but starting off, this is $100 account, so you can only put so much money in. I'm sorry, you can only put so much put such a big lot size, and it's depending on how much your balance is. So you can't go and put $1 per lot size on a dollar account. You would need at least $1,000 just to do a standard lot size, but that's you don't even need to worry about that right now. Any questions as of right now? Because I feel like we're at time. I was like 7 minutes late trying to log on and get through these technical difficulties, but that's where we're at with it right now. If there's no questions about the broker, anything that you're seeing right now, I'm gonna go to the last slide, I believe. And this is what you kind of want to be looking at right here. So far as account size, this is what you call account management, and account management is more important than being right or wrong in a trade. All right, I want you guys to understand that, and that's you'll understand why, because when you go to open up a trade, you're always going to take some drawdown. Not always, sometimes you don't, but on a trades where you know it might take some drawdown and you plan for it because that's what your stop loss is for, you might take some drawdown. But if your lot size is too large and you take that same amount of drawdown, it can blow your account. You got me? So that's why I tell you guys to stick to 0.01. Obviously, $100, you don't want to go over 0.02. This is a general basis of where you want to be situating yourself within the market at the proper account size, at the proper lot size. All right. So any questions over anything that I went over tonight? We're going to go deeper into kind of account sizes, and I'm going to do some numbers with a little bit bigger accounts tomorrow, so you guys can see what that looks like. And because obviously, you know, nobody's going to be retiring off of a few pennies per trade. So I'm going to show you guys how to consistently make $50, $150, $250, $300 a day just in these markets. And that can happen in I'm talking about a matter of minutes. Not necessarily minutes, not with a 0.01 lot size, but with 0.10, anything below a 0.10, you can easily make anywhere from $50 to $300 easily in a morning. All right. For those who have seen me out later on, I don't think anybody is on here, but those who have seen me make that type of money on here, you know, it's something that you can do consistently every day, as long as the markets have some volatility in it. And as long as you understand what you're doing in the markets, this is something that you can consistently do to replace your income, supplement your income, or wherever that $200, $300, $500, whatever it is, would be for you in your point of life. All right. Outside of that, any questions? Right. Well, there's no questions. It's your favorite trading instructor, Lionheart Doyle. You guys can always email me if you have any questions later on. info@lionheartmotivationfactory.com. If you are ready to sign up for your monthly membership, it is going to be lionswallstreet.com. The website will be completed soon. And from there, we're moving on. But I will see you guys tomorrow. And then if you guys do want to hop on the session with me tomorrow, I'll open up the session at 9 o'clock tomorrow. All right. 9 o'clock a.m. 9 o'clock a.m. for the New York markets. And you can trade live with me. And that's the other thing that you can benefit from as well as a monthly member. You basically get to trade with me, so you don't have to worry about losing large sums of money, not knowing what you're doing. You can literally trade with me, take the same trades that I take. I'm going to tell you exactly what button to press, when to press it. And that's the beauty of being able to trade as part of this group. All right. Outside of that, I will see you guys tomorrow. You guys have a good evening.